President Trump has already filed the appeal. The president responds to a judge temporarily blocking his attempt to fire Fed Governor Lisa Cook within hours of the Senate committee, the Banking Committee, advancing Stephen Miron's nomination to the Fed.
Hello and welcome to The Week Ahead on Nomura Podcasts. I'm your host, Andrew Ticehurst from our Global Markets Research team, and today's Friday, the 12th of September. The Fed policy meeting next week is now in full focus against a highly unusual backdrop, as you heard there, outlined by Joe Matthew from Bloomberg. So this week we'll be discussing that with Ruchir Sharma from our research team in New York. Ruchir will also cover an expected rate cut from the Bank of Canada next week too. I'm also delighted this week to introduce a special guest, Nomura's Head of Global Rate Sales, Darren Shames. Darren sits within our global markets business, and what you'll hear from him is not investment advice, but I think some valuable insights on markets. We've also got George Buckley from London to discuss the latest from the ECB and the Bank of England meeting next week. Yuichiro Nozaki from our Tokyo office will be along to discuss the Bank of Japan and the latest political developments there. And Nabila Armani from our team in Singapore will preview central bank meetings in Indonesia and Taiwan next week. Northern summer holidays are over, but things are clearly heating up and there's much to discuss. So let's dive in. Let's go straight to the US. I'm delighted to be joined here by Ruchir Sharma from our US research team. Ruchir, let's get straight to it. We've just seen the US August CPI report. What was the message there for you?
Hey, Andrew. So it was sort of a tricky report, and the core CPI inflation that was close to our expectations. But we got some evidence that tariff continues to pass through to prices. However, implications for core PCE were quite different. So looking at that, on the upside, volatile services components such as airlines, lodging, and rent OER, they unexpectedly accelerated. However, core goods, where you were actually looking at the signs of tariff pass-through, they were short of our expectations. Some of the components, definitely like apparel, used vehicle prices, new vehicle prices, they rose, and we continue to expect those prices to rise. However, those are the components that are sort of downweighted and are don't feed into core PCE inflation that much. So just going about what it means for the core PCE, which is actually the Fed's preferred measure, CPI's airline fares, which surprised to the upside, they aren't an input. Rent-related components, they have a smaller weight. And finally, some of the components like computer and information services, they surprised largely to the downside and they're weighed more in the core PCE. So we think that core PCE would actually just round to 0.2% from our pre-CPI estimate of 0.35%. That's a subdued trend. So we think that August inflation data overall, they weren't as dovish as our core PCE inflation tracking estimate implies. Tariffs still are a problem. Tariff-sensitive core goods, they are continuing to rise despite pockets of weaknesses. But again, that said, this print should make the Fed comfortable to ease.
Yeah, look, speaking of the FOMC, we do have 25 basis point rate cut as the central case. Can you expand on that? What else can we look out for next week from the Fed?
Yeah, definitely. So the next week, it's the Fed week, and it's going to be an interesting one this time. We expect the Fed to resume easing and cut by 25 basis points. And the data that we saw today, specifically the inflation data, I think that should sort of finalize the case for them to ease. So there's going to be an interesting meeting since we expect some dissents, probably 3 or 4. We expect Governor Waller, Bowman, and Steve Miron, if he gets confirmed in time, they'll likely vote for a larger, that's a 50 basis point cut, while we expect that there's a good chance of a hawkish dissent from the KC Fed President Schmid. Also, just an update for the Governor Cook thing. So a federal judge granted a temporary restraining order blocking Trump's firing of Cook, which means that she can stay on the board for now and carry on her duties. That said, again, it's the September meeting. It's the time of the year where you have dots and you have the summary of economic projections. And we think that there's going to be a clear communication that the cut that the Fed is doing, it's more of an insurance cut, and the pace would be gradual because still there are price pressures. years. So for the dots, we think that the median 2025 dot, that's going to be unchanged. And there's a good chance that 2026 median will likely shift slightly lower, and the average projections will be more dovish across the horizons. As for the SEP, I think that given the data that we have had as of now, there's a good chance that the Fed actually slightly bumps up the growth forecast. They actually mark up the risks for that there's an upside risk to the unemployment rate, and price pressures are still existing. So that's our thinking about the Fed next week.
Got it. Thank you. And finally, Rashir, let's go north of the border because Bank of Canada has a policy meeting too. What are you expecting there?
Yeah, so for the BOC, actually, things are pretty convoluted, and we now expect that the council would resume easing and they'll lower the policy restriction by 25 basis points at the upcoming meeting. So the July statement, if you look at the previous meeting, that was actually somewhat dovish. It highlighted that there are still headwinds to the growth, and the BOC actually retained a reference to easing further. So looking at the data that we've got so far, real GDP growth actually surprised to the downside and came in below R and BOC's forecast. It was minus 1.6%. And this was because the impact from front-loading exports and inventory building that actually pushed up the growth in Q1, it reversed. And finally, looking at the labor markets, the situation is pretty grim. The August labor force survey was particularly weak, and with the second consecutive contraction in employment, the unemployment rate actually breached the 7% threshold for the first time since mid-2016, excluding the pandemic. There's an important thing that we have the August CPI report just before the day for the BOC meeting, and definitely it's an important data point, but broadly looking at the data and looking at the economic scenario over there, I think that the medium-term risks are for inflation are skewed to the downside, and that's why we think that the BOC is going to resume easing, cut in September, followed by another cut in December.
Rashir, that's great. Thank you. Hope you have a great week ahead. And now to our special guest, Darren Shames. Darren sits within Nomura's global markets business in a very busy dealing room in New York as head of global rate sales and head of global market sales for all of the Americas. I did want to stress what you'll hear here is not investment advice, but I think some interesting insights from someone with really deep experience in this space. So Darren, that's a long introduction, sorry, but thank you for coming on the podcast.
Thank you, Andrew. I have to say that is quite the kind introduction, quite the honor being the first salesperson globally to be on this podcast. So thanks for having me.
Yeah, fantastic. Now, look, you have been traveling around the region through Asia, of course. We're lucky to have you with us here in Sydney today. So I thought I'd start by asking, as you travel around, what questions are you getting from investors in this part of the world? What's top of mind?
Great question. I think top of mind, most of our questions have really been around the resiliency of the U.S. economy, especially after last week's disappointing payroll data. And you think about the sequencing with this week's CPI report being released, raises a lot of questions around whether we potentially enter a stagflationary regime in the U.S. Outside of just the overall economic backdrop in the U.S., many questions around the Fed independence, and the potential glide path for the easing of monetary policy in the months to come. Currently, after last week's non-farm payroll, which disappointed markets, we've seen market repricing move rather swiftly to the dovish end of expectations, with a terminal rate now being priced below 3%. So we've moved from a rather benign environment to a somewhat more extreme dovish view in the market.
You mentioned the threat to Fed independence there. This looks like a very big deal. Can you expand on that and some of the focus points there?
This feels like one of those unprecedented moments for markets. Clearly, a potential new paradigm where we're putting at risk the last 45 years of how the Fed has operated as a central bank in the United States. The real risk here is that this independence is put at risk. And I think the first potential example of this has really been Lisa Cook, and whether or not she's being sidelined by the Trump administration as they look to potentially offboard her from the Fed and find a replacement for that seat. Now, this also brings into question the future of Chairman Powell and his tenure at the Fed. And I think for us, Lisa Cook still remains, I think, the focal point of markets and whether or not she's able to vote in the September meeting and if she is allowed to stay on the Fed. So the Supreme Court ruling in very short order is going to be critical for markets and how they interpret Fed independence in the very near term.
Got it. And look, with this threat to Fed independence, and I guess stepping back and looking at the big picture, we've got gold at record highs and S&P bouncing around record highs too. We've got credit spreads at sort of pretty tight levels. How do we square the circle on all of that? Do you think that global investors are being too complacent right now?
I think that's exactly what we've seen. I've been struck by the complacency that's really emerged in markets post-Liberation Day. So we're 5 months later, and we've only seen financial conditions ease following one of the biggest vol shocks of the year. What does that mean? It means tighter credit spreads, lower rates, and higher prices in equity markets. So if I look at vol as just the level or barometer of complacency in markets, vol in virtually every asset class has only gone in one direction following Liberation Day. So lower vols in FX, equity, and rates markets around the globe, but definitely in the U.S. markets. Now, in my opinion, this dynamic seems wildly inconsistent with the fat tail risks that exist in the U.S. economy and the political risks that seem heightened both not in the U.S., but globally when you look at areas of the world like France, what we've seen over the past weekend, and in Japan. And look, we haven't even really touched upon the ongoing fiscal woes that we're seeing globally. There has been a sharp deterioration over the last several decades in DM economies. And I think that is most obvious in the UK, in Europe, Japan, and to a lesser degree, the US, but it's still very topical. And I think that's one of the reasons why we've seen long end yields languish globally and 1030s curves steepen out toward the wides of their recent ranges. Now, the other thing I think worth touching on in your question is just the de-dollarization story that's ongoing in the background. This is a theme that we're witnessing, and I have to always remind investors that this is a story that moves at a glacial pace. This is not something that you see turn up in the data month to month, quarter to quarter, but this is a multi-year story. And we've already seen signs of it filtering through in markets and in our flows as a dealer. But to us, this is one of the main reasons when there is a clear lack of an alternative currency, we've seen record highs in gold made over the last couple months. So the de-dollarization story is something that we're going to be living with for some time.
Excellent. Look, I guess the summary is elevated asset prices, but no shortage of risk out there as you identify. I guess the US summer is drawing to a close, but things could heat up over the next couple of months. Darren, thanks so much.
My pleasure. Thanks for having me on, Andrew.
We are determined to ensure that inflation stabilizes at our 2% target in the medium term. We will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. We are not pre-committing to a particular rate path.
Now, moving to Europe, I'm very pleased to be joined by George Buckley, our Chief Economist for Europe and the UK. George, the ECB have just met, and I played a snippet there from Lagarde's press conference. No change to rates as expected. Were there any highlights for you?
Well, I think the highlight is what we already know from the ECB, that Lagarde thinks they are in a good place, and that's her exact quote. And I think the important thing about this is that if we take our forecasts for economic growth for the second half of this year and you add them to what we got in the first half, then economic growth on average is running around about trend. Maybe 1.2%-ish. You've got inflation, which is running a target, and you've got interest rates by their own calculation, which are at neutral. I mean, the question is, what's not to like about that situation? We are completely in equilibrium if you believe all those numbers and you believe the equilibrium numbers. So it's going to take a shock of some sorts to shift us away from this, and that's why they're happy with rates where they are. That's why we have a forecast of interest rates staying at 2%. There's no need to move them at the moment, or probably for quite some time.
Got it. Growth at trend, inflation at target, and rates at neutral. It sounds like a very nice little world. On the data front, we have some European and perhaps more importantly, some UK inflation data next week.
That's right. And the reason the UK numbers are more important is because the European numbers are a second estimate and they don't often get revised, or if they do get revised, not very much. So the inflation numbers for August for the UK are more important. And I think what's really going to be in focus here is we had some surprises on the upside from things like transportation, namely airfares. Will that come back down again? Is it just pure volatility? Is there something more to it than that? Is it the fact that people really value their holidays? There's a lot of demand for airfare for flying, and therefore they can afford to put prices up. Or is it less sinister than that? We think that services inflation could moderate a little bit. The Bank of England really would like to see services inflation come off from its current 5% level to something which is much more consistent with the 2% inflation target.
Okay, understood. Bank of England, you mentioned there, they do meet next week. We've also got Norges Bank meeting. So can you share some thoughts on Bank of England and maybe squeeze something in on Norges?
Yeah, absolutely. The Bank of England, the interest rate decision hopefully will not be that exciting. No one's expecting any move from the Bank of England, remaining unchanged at 4%. We don't think there's going to be any change in guidance, although I don't think it's going to be that long until they need to change their guidance, because they're still talking about restrictive interest rates, need to cut interest rates. We're not very far away from the top end. We might even be at the top end of the neutral zone. The real question is what they do on quantitative tightening. Interest rates in markets are very high, 10-year rates over 6%. That doesn't sound very consistent with the what's going on fundamentally in the economy. So I wonder whether they might that they could reduce the pace of QT. We don't think they will, but it's not a high conviction call that they stick with 100 billion. We're out of consensus there. On Norges Bank, we're looking for a rate cut, a quarter point. We think they're going to continue at a quarterly pace. Inflation's still a bit high, but Norges Bank expected that. So we still think they can deliver that quarter point cut.
Okay, understood. George, always lovely to talk with you. Thanks so much.
Thank you very much, Andrew.
Let's go to Japan and have a chat with Yuichiro Nozaki from Nomura's research team in Tokyo. Hey, Nozaki-san, thank you for joining.
Hi, Andrew. Thanks for having me.
Excellent. Look, let's start with the politics this week. This looks very interesting. Prime Minister Ishiba has announced his resignation, and there seems to be a lot going on there. Could you help bring us up to speed, please? What's been happening and what could come next?
Okay, thanks. Prime Minister Ishiba announced his resignation as LDP leader on September 7th. As a result, LDP will hold a leadership election on October 4th. At this moment, 3 candidates, Motegi, the former LDP Secretary General, Hayashi, current Chief Cabinet Secretary, Kobayashi, the former Minister for Economic Security, have already showed their intention to run the election. In addition, Takaichi, who placed second in the previous election, and Koizumi, who came third, are expected to enter the race, but have yet to announce formally. This time, the party will hold a leadership election using a system that gives relatively more weight to party members' votes. While Diet members' votes remain important, in this system, well-known candidates tend to have advantage under the system. Public opinion polls show that Takaichi and Koizumi enjoy strong support. Regarding policy, Takaichi advocates fiscal expansion and monetary easing. She supported a consumption tax cut in the July election, despite the LDP's oppositions. Previously, she opposed raising interest rates, but has been silent on monetary policy over the past year. Given current inflation concerns, public support for monetary easing has waned. That's why she stopped to mention monetary policy. Koizumi maintains a neutral stance on economic policy, similar to Prime Minister Ishiba. Regardless of who wins, the ruling coalition lacks majority in both upper and lower house. complicating governance from autumn onward. Opposition parties demand fiscal expansion, including tax cuts, so the next prime minister will likely need to pursue some fiscal stimulus.
Okay, that is interesting. So a number of candidates, and yes, I think markets would be extremely interested if Takaichi prevailed in that leadership election. Hey, let's turn to the Bank of Japan, very important central bank, of course, and they're meeting next week. What are you expecting there?
We expect the BOJ to keep the policy interest rate unchanged at the upcoming meeting. While the BOJ still maintain its basic stance for rate hike, they are taking a wait-and-see approach because they are not sure yet how the U.S. tariff policies will impact things. So far, there hasn't been enough data to gauge the size of effects. Also, as I mentioned earlier, Prime Minister Ishiba announced his intention to resign. Since the next leader of the LDP hasn't been chosen yet, there's a lot of domestic political uncertainty, which makes it harder for the BOJ to change its policy in September. Almost all investors expect the policy rate to stay the same. These meetings won't include a quarterly outlook report, so focus will be on Governor Ueda's press conference afterward. We think that there are 4 main points to watch in the press conferences. First, how they assess the impact of tariff policy on the domestic economy. Second, the view on the U.S. economy. Third, food inflation. And fourth, the rising political uncertainty.
Okay, very good. A lot to look out for there. Nozaki-san, thank you so much.
Thank you so much.
Now, across Asia, there are a couple of other central bank meetings to look out for. So it's lucky I have Nabila Armani from our research team in Singapore here with me to help take us through this. Hey, Nabila, let's start with Indonesia. Bank Indo is meeting. What are you looking for there?
So we actually changed our call and now expect Bank Indonesia to leave its policy rate unchanged at 5% instead of cutting by another 25 basis points this month. We have previously flagged that BI could delay the next rate cut if balance of payment pressure persists following recent protests. While the protests are now peaceful, IDR has weakened after the cabinet reshuffle, which saw Finance Minister Sri Mulyani being replaced. And this, in our view, represents a negative shock for investors and likely increasing fiscal concern significantly, making BI cautious of capital outflow risks. Still, we expect the tone of BI's policy statement to remain broadly dovish as before, with officials indicating again that BI will monitor the room to lower policy rates. And currently we assign a 70% likelihood to our own halt forecast versus 30% to a 25 basis point cut, which BI could rationalize with a supportive external backdrop premised on a higher likelihood of a Fed rate cut this month.
Okay, understood. Thank you. So Bank Indonesia most likely on hold. And that leaves the other central bank in the region, Taiwan. We've got the CBC meeting. I think the team there have been expressing positive views on Taiwan. So what does that mean for the CBC?
Yeah, so we expect the CBC to leave its policy rate unchanged as well this month, likely keeping its wait and watch strategy. And this is mainly due to 3 key reasons. Firstly, GDP growth has performed exceptionally well in the first half, and the strength in AI-led exports and production has continued in the third quarter, which suggests the third quarter GDP growth could be better than anticipated. Secondly, CBC is likely wanting to preserve ammunition for when it's most needed, which is when there's a clear evidence of a slowdown rather than deploying insurance rate cuts when economic growth is still robust. And third, there is also high certainty around the private consumption outlook going forward. So given the financial stability risk around housing market have largely dissipated in Taiwan, we flag the risk of RRR cut in next week's meeting, though this is not our base case, more in December, actually. We forecast the CBC to remain on hold until the end of 2026, setting these as our base case, but we acknowledge the risk of the CBC turning more dovish in the fourth quarter and beyond if it sees rising downside risk to its growth outlook, particularly due to the tariff impact and also the downside risk in domestic consumption as well. Yep, that's it, Andrew.
Okay, good one. Thanks, Nabila. Thanks so much.
Thank you.
And finally, 3 quick highlights for the rest of the region. First up, China. We expect a weaker reading for July industrial production, a slight uptick in retail sales, and a weather-related boost to fixed asset investment. All up, China growth momentum still seems a bit subdued, with the manufacturing and property sectors remaining a drag. Elsewhere in Australia, we expect job growth of 18,000 persons in August, with the unemployment rate likely steady at 4.2%. And finally, New Zealand, we expect a small contraction in Q2 GDP to be reported there, but possibly less negative than the RBNZ had forecast. Things do seem to be bottoming out and starting to turn up in New Zealand, looking at recent transport, migration and survey data. So let's leave it there on a happier note. Okay, so there you have it, our views on major market themes and what to look out for next week. This podcast has been written by Andrew Ticehurst and the Global Markets Research team and expertly edited and produced by John Dalton, as always. Thank you for listening in. If you did enjoy the podcast or would like to hear more, please like and subscribe to Nomura's podcasts on Apple, Spotify and SoundCloud, or wherever you go for your podcasts. And if you have a moment, please leave us a review. And as we always say, it would make our day if you could press a few buttons and share this podcast with a colleague or a friend. For more, log into NomuraConnects.com to keep up to date and to keep on listening. Thanks, goodbye for now, and see you next week.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice nor is legal, regulatory, accounting or tax advice and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomuraconnects.com.